All right, welcome in. If you follow the news at all or you look at your investments, you might know that on Monday, July 19th, that was yesterday as I'm recording this, you did have the market pull back quite seriously on renewed concerns about COVID, potential greater lockdowns or restrictions. Now, nobody, to my knowledge, thinks it's going to be as bad as it was, in terms of lockdowns, restrictions. We're not going back to the spring of 2020, okay? But nonetheless, there are a lot of forecasts in the air right now for the economic rebound. Did rebound very, very quickly. There was some news that broke yesterday that the actual recession ended in April of 2020. So it was like the fastest recession in modern history since record keeping has begun. So nonetheless, there is still some concern though on, might some of the earnings forecasts be diminished just based on further COVID restrictions given the Delta variant. Okay, so looking at a chart here for the S&P 500, the index of the big US stocks, and here's what happened yesterday. So S&P 500 pulled back 1.59%. That's big, but it's not extraordinary. There have been worse pullbacks. In fact, I can see one right here. Here's one from October 2020 when the S&P 500 pulled back 3.53% in one session, okay? So yesterday's was not that horrible, but here's what is very interesting, and I noticed this yesterday afternoon, mid-session. You see where my cursor is? On the 50-day moving average for the S&P 500, the average of the 50 past closing sessions, okay? And you see that it found support right there at that 50-day line. So what does that tell you? Tells you that the big institutions, their algorithms, the human factor that may come in and look over the shoulder of the algorithms, they decided at this juncture not to sell deeply, but to kind of step in, buy some shares, support some stocks. Let's go back and look at this. Here is where it happened again recently, support at the 50-day line. And what happened? It rallied. Here you go. It tagged the 50-day line. Had a couple false starts over here, but that's okay. That was still good support. Tagged here, rallied, pulled back again, rallied again. That shows you that same phenomenon. Same thing here. Now it fell a little bit beyond the line here, but rebounded very quickly. See, on this day, that was March 4th, it fell, it finished the session 1.3% below the 50-day line, but look what happened. The very next day, it rebounded and closed 0.5% above the line, okay? More support right here, kind of fell down here. That did offer some big buying opportunities though, see? As you can see, a gap up right there, a gap up right there, a gap up right there, a gap up right there. What does that mean? It means that institutional investors were identifying some places where they believed valuations of equities were low and they could step in and buy at lower prices. Oh, and guess what? That strategy works, doesn't it? Because what happened? They've been paid off in their investment because it's rallied higher. S&P 500 was at a new all-time high last week on the 14th. So that's a really good sign. And then we're having a nice rebound today. It is almost 12:30 p.m. Eastern time as I'm recording this. Very nice rebound so far today. We can look at a 5-minute chart. I find that often instructive. So there you go. You see some nice buying at the open, then a gap up. Okay, so we are on a nice trend higher today, pretty close to closing that gap, actually. Let's see here. So the high up here is 43.25, the low over here, 43.24. All right, my viewers, we did close that gap. So very good sign there today. All right. So this is why it's so important to look at the charts, because last summer I was working with a new client and it was interesting. She had a financial advisor and I don't think she'd talked to the person in a long time. Don't get me started on bad financial advisors. I'm starting to think that's most of them, actually. She did not want to look at her portfolio in August of 2020 because she was so terrified of what happened back in March and April of 2020. So let's just go back here. I'm going to go backwards a little bit on the chart so I can show you what happened. All right, there's the pullback, right? Began in February. We all remember this. And we had some buying. This is where this is where the recession ended, basically in April, because markets started to jump higher. So look over here. By August, things were pretty good. Let's see. We're back to 33.87. Yeah, you were pretty much, by the end of August, you were back to where you were before that pullback began in February. Okay, I'm going to reset the view to today. And that's why it's so important to understand the charts, understand at least the basics of technical analysis so you understand what's happening in your portfolio without having to say, I'm too afraid to look. You should never be afraid to look. Yes, markets go up, markets go down, but you should never be so out of the loop of what's going on in your own portfolio that your decisions are driven by fear, not by what's exactly going on. Fear and guesswork, by the way, because that was just ridiculously wrong guesswork. And I'm not afraid to say that. I'm not going to coddle people and say, oh, they didn't know, they worked with an advisor. You need to know. Nobody's going to care about your money as much as you do, and you may have one of those crappy advisors that never calls you. There's a lot of them out there, people, I promise. Okay, I want to show you some other asset classes today. So we looked at the S&P 500. Here is the Russell 2000 small cap index. Now you're seeing here, this is not performing as well recently as large caps did. Small caps are a little more tied into the overall performance and the economy in the United States. This is a domestic index right here. Yes, there are overseas small cap indexes. I'm not going to look at one of those today, but I can do that in a future video. Now, there is kind of a good sign here. So far, it's holding above its 200-day average, okay? That's a longer-term trend line, or a price line, really, that shows you the moving average of prices over the past 200 trading sessions, okay? So it's obviously going to be lower than the 50-day just because it is a longer term. That's typically how the moving averages work. So if you go back over here, you did see we had the pullback back here in the fall in the Russell 2000 when small caps were underperforming large caps for a while back there. Did find support at the 200-day line. There again, you found support at the 50, so that was a better sign. This index has not tagged that 200-day line since September, so not terribly surprising to see that we're kind of seeing a bit of a sell-off right now. Nothing to panic about. You should have some exposure to small caps. Does not need to be the only thing you have, even though small caps tend to, over time, outperform large caps. That's called the small cap premium. It doesn't always work in all market cycles. And I had a client ask me one time, well, if that's the case, why don't we just keep small caps and don't even diversify? I understood where he was coming from. It was a good question. And the answer is, for exactly like times like this, you want those assets that are performing better. It's very, very emotionally difficult to sit through a correction if this is the only thing you have. But say you also had the S&P 500. Let's see here. S&P 5, there we go. You also have the S&P 500. You'd probably feel a little better about what's happening today if you had both of those things in your portfolio, okay? Not suggesting those should be the only two things. Just giving you a very, very basic explanation of some diversification right there. Okay, so I want to show you on the topic of diversification. This is the Ishares Msci Ifa Etf. It is an index that tracks stocks outside of North America from developed markets, so developed Europe, Australia, Japan. You get the idea. Okay, so what do we have happening here? Well, this one also sliced right through that 50-day line, right? And that happened back at the end of June. Now, international stocks for quite some time have underperformed US. And I wrote an article for MarketBeat yesterday. Here's a look at it, talking about the fact that there are some analysts out there from LPL, from Wisdom Tree, who do believe that developed market international stocks, especially high quality stocks, meaning those with good earnings growth, strong return on equity, good balance sheet, that those high quality international stocks could outperform US stocks in the second half of the year. Not negating that, we absolutely could see that. Right now, what we've got, even though this correction looks crazy deep, it's actually only 7% decline, okay? And it's still holding nicely above that 200-day. Let's see. This one has not touched its 200-day since October. So again, not a big surprise to see a pullback over here. Let's go over to a weekly chart of this one and take a look. So yeah, that could be a little bit of a rocky ride, but you absolutely need to understand, once again, how your stocks are performing. So even though you had that big jump in there, this is for this week, and we're only on the second trading day of the week, so this just reflects Monday, Tuesday, that big gap right there. You might be in a little bit of a freak out about that, but if you know how to gauge the support above these key moving averages, you'll understand that, hey, maybe the performance here is not something to panic about at this time. Maybe you'll understand, hey, I need to have these different types of asset classes, large cap, small cap, overseas stocks, some alternatives like commodities or real estate, because all of these can work together to balance each other out within your portfolio. Let me show you one more thing before I head out today. Okay, this is the iShares Emerging Markets ETF. Now, this is a weekly chart, and this is in a correction of 12% since pulling back from a high over here in February. Let's go over to a monthly chart, and you can see very quickly that was an all-time high back here in February. Now, emerging markets, let me pop back over to a monthly, show you this. You see how these have kind of underperformed over the years? They have periods of time when they gain mightily, like right over here. This too jumped up very, very nicely after the big COVID pullback. Kind of been a little bit flat in recent months, but you had a very nice run up here between April and February of this year, so nothing to sneeze at there. Let's go over to a weekly chart of this ETF. So there you see, so it's saying it's a flat base. We already knew it had only corrected 12%. I just showed you that. So that constitutes a flat base because it's correcting less than 15%. So that's not so bad right now. Also, this is another one. What do you see here? Do you see what I'm looking at? Support right there at that 200-day moving average, right there. Now, back in the old days, you had mutual fund managers who, and they still do, by the way, this is still how it works today. You have analysts, you have a team of managers and analysts who watch the market, who get in there. You also have a lot of the trading is automated. I am not suggesting there's no human factor. There is. Now, this one just tracks an index, okay? So just so you know that. This one just tracks an index, but if you, and it's an ETF, not a mutual fund, but the point that I'm trying to make is you have a combination with all these individual stocks, because this is just a basket of stocks, this ETF. So it's a basket of stocks, and for all of those, for each of those stocks, you've got institutions who own them, mutual funds, hedge funds, banks, insurance companies, foundations, university endowments, all of these, you've got a combination of algorithms, the artificial intelligence, and the human analysts who step in there. So you see that? The humans and the robots are all agreeing right now that there is some reason to step in and buy at that 200-day line. So I'm going to go over back, I'll wrap things up today at the S&P 500 because that's just a little more of a gauge of what most American investors are looking at, and throughout the world people are looking at this as well. You definitely see some support right here. So this is why looking beyond the headlines and what's actually happening on the charts is so, so important for every investor and trader, even if you have a financial advisor, because nobody's going to care about your money as much as you do. And this gives you a very informed way to ask questions. All right. Thank you so much for watching today. I appreciate you.